Hey, this is Phil and it's your Friday video update. So the Fed rate hike talk is on again, and I've gotten calls from customers concerned about what's going to happen and so forth. And remind you again that typically when the Fed raises rates, it actually helps mortgage rates in the near term. We'll see what happens this time around. There's talk of it happening March 15th, but just we have to wait and see. I wanted to talk about two things that a rate hike or rising rates can impact. First, Pulsonomics did a survey of about 100 industry experts, economists and housing industry experts and so forth, and asked them at what point do interest rates need to get before they negatively impact house price appreciation. And the majority of the survey respondents, and you can see it here in this chart, feel that somewhere starting at 5% and going up to 6% is where it would start having an impact on housing appreciation. Well, the industry forecast by Fannie Mae and Freddie Mac and so forth for interest rates for 2017 all have their expectations to be that rates would not get up to 5% this year. So that's good news, and I think something you can take some good solace in and pass that on to your clients. But we all do know that rates have been going up and are probably going to continue to go up some throughout the year. So I wanted to talk about how that impacts affordability. And you can see here on this chart that for every 0.25% rate increase on a $400,000 loan, you see that the payment's going to go up about $58 a month. Okay, that's not horrible, but it's $58 a month. And if the rates go up a full 1%, you're talking somewhere in the $250 range approximately in increase in monthly payment. So obviously nobody wants to see that happen to them all at once. But as the rates slowly rise, I know that's kind of the impact of rising rates on payment. But the chart also shows here, look at this chart, that as rates go up, basically the affordability of that same house drops. A $400,000 mortgage with a 0.25% increase, to keep the payment about the same, it drops down about 2.5%, and so forth. Every 0.25% more, it drops down another 2.5%. So the chart shows you that as rates go up, either affordability goes down or payments go up. And that's something that certainly has some people concerned and has some buyers concerned. And so it certainly is a reason to get out there and get buyers shopping and try to find a home and get locked in an interest rate sooner rather than later. But this isn't a sky is falling scenario. We still have excellent interest rates, historically very low, and it's not going to overly impact a person's ability to qualify for their loan. So I hope that helps. I hope that gives you some information that you can share with clients. And if you need some backup on that, you want to give a client my phone number, have them call me, and I'd be happy to go over this with them. Please do so. Forward and share this to any other real estate agent that you think might find it helpful. And please remember to call me if there's anybody that I can get pre-approved and ready to go out and buy a home. Hope you have a great weekend. Thanks for listening, and I will talk to you next week.